When the market gets close to an all-time high and we see a divergence between RSI and price action, it usually leads to a big crash, except for the COVID crash. Today we have a lot to discuss about everything you need to know before the next potential crash, so stay with me.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow.
Hello, ladies and gentlemen. My name is K2. Today is August 10th. And I'm here to show you the evidence of a recession and the upcoming market crash. Without any further ado, let's dive in. The U.S. economy is likely already in a recession. U.S. construction spending has declined year over year for 6 straight months. Month over month, construction expenditures have fallen in 10 out of the last 11 months, the longest streak since the financial crisis. This type of decline has never happened outside of a recession. U.S. manufacturing jobs are falling. And that's a huge red flag for the economy. Manufacturing employment has declined in 17 of the last 29 months. Even more concerning, jobs in this sector have contracted for 4 consecutive months, the longest streak since the 2020 crisis. This isn't just a slowdown. This is the continuation of a manufacturing recession. And remember, manufacturing is one of the most important leading indicators of economic health. When factories cut jobs, it usually means businesses are seeing weaker demand, lower production, and preparing for tougher times ahead. Historically, every time we've seen this kind of sustained weakness in manufacturing, it has either overlapped with a recession or signaled that one is already underway. Right now, all the evidence is pointing in the same direction. The manufacturing recession is not only here, but it's deepening. The Bureau of Labor Statistics just revised U.S. job numbers down by 911,000 for the 12 months ending March 2025. This is the biggest annual revision on record, even worse than expectations of a 700 to 800,000 revision. To put this in perspective, the previous record was back in 2009 during the financial crisis, when jobs were revised lower by 902,000. This means the labor market has been much weaker than we were originally told. And remember, this isn't the final word. The official non-farm payrolls revision for this period won't come until February 2026. Right now, 62% of Americans expect unemployment to rise over the next 12 months, one of the highest readings we've seen since the 2008 financial crisis. That number has doubled in less than a year. And here's the kicker. Such levels have never been reached outside of recessions. Even more surprising, the top 33% of income earners are now more pessimistic than the middle and lower classes. Historically, when higher earners lose confidence, it signals real trouble ahead. In every past cycle, a shift in expectations this large has been followed by a surge in unemployment. The labor market is cracking, and the data proves it. Remember what happens when the Fed starts cutting rates? If you look at the chart on your screen, you'll notice that every single time rate cuts begin, the 30-year yield actually starts moving higher. And historically, that move has always led to a major market crash. This pattern has repeated itself over and over again, in the early 2000s, in 2008, and even around the COVID crash. Rate cuts might sound bullish in the short term, but they're often the signal that something much bigger and more dangerous is brewing in the economy. So here's my question for you guys. When do you think the next crash is coming? Personally, I believe we're looking at 2026. But I want to hear from you. Drop your thoughts in the comments below. U.S. temporary help services jobs are falling at an alarming pace. Since their peak, temporary employment has dropped by more than 21%. That's an even steeper decline than what we saw during the 2001 recession. And here's the shocking part. Temporary help jobs compared to total employment have now tumbled to their lowest level since the 2020 crisis. Why does this matter? Temporary jobs are one of the best leading indicators of the labor market. Companies cut temps first, before they start laying off permanent workers. So when we see a collapse this deep, it usually signals that the broader job market is about to weaken in a major way. Historic market concentration is continuing to reach new extremes. Right now, the combined weight of S&P 500 stocks, with a 3% or greater share in the index, has hit a record approximately 32%. To put that into perspective, this number has tripled in just the last 8 years. For comparison, at the peak of the dot-com bubble in 2000, that figure was under 10%. Today, 6 companies each hold more than 3% of the S&P 500, and leading the pack is Nvidia, which alone makes up a record 8% of the index's total market value. The takeaway? The market has never been this concentrated in history. And while that concentration can drive indexes higher in the short term, it also makes the entire market more fragile. Because if just one of these mega-cap names stumbles, the whole index can come crashing down with it. There are now a record 312,000 new homes for sale in the southern U.S. states. That's 21,000 higher than the August 2006 peak, just before the housing market crash. To give some perspective, during the 2020 pandemic, the number of new homes for sale in the South was almost half of what it is today. Meanwhile, new homes for sale in the West have increased by 40,000 over the last 5 years, reaching 111,000, near the highest level since 2008. Inventory in the Northeast and Midwest is also near cycle highs, though it still remains below the 2006 housing bubble levels. The big question is, how much longer can this housing market run before it hits its breaking point? Investors are increasingly hedging their positions as uncertainty rises. Over the last 7 days, hedging ETFs have attracted $6.0 billion in net inflows, the most since mid-April. This follows $5.7 billion in inflows the week prior, far above the average seen in Q4 2024. Gold, cash-like assets, long volatility, and inverse ETFs have now seen 6 consecutive weeks of inflows, the longest streak since the March-April sell-off. Meanwhile, leveraged long ETFs have experienced around $5.9 billion in net outflows over the last 2 weeks, the largest since at least early 2024. All of this points to one thing: uncertainty in the market is rising again, and investors are preparing for turbulence ahead. And it's not just jobs, housing, and market concentration. Even lumber prices are flashing a warning sign for the U.S. economy. Lumber is one of the first indicators to react to changes in housing demand and overall economic activity. When prices start to fall sharply, it usually signals slowing construction and weakening consumer demand. Given everything else we've seen, rising inventories, falling temporary jobs, and a cooling housing market, the decline in lumber prices adds yet another red flag to the picture. All right, ladies and gentlemen, that's it for today's video. If you have any questions, drop them in the comments. I'll get back to you. Thank you so much for watching. If you enjoyed the video, don't forget to like and subscribe. Thanks again, and I'll see you next time.